Now, let's look at the numerical example of cash flow estimations in the capital budgeting process. Suppose our new project is to purchase a new equipment, and this new equipment is to replace an existing equipment. Now, suppose the new equipment will cost us $100,000, and the shipping cost and the installation cost of this new equipment in total is $50,000. So after purchasing the new equipment, we have to have it shipped and installed, and that will also cost us $50,000. Now, $100,000 is the cost of the equipment, $50,000 is the shipping and installation cost. In accounting, we can add these two numbers up and get the depreciable basis, which is $150,000. So instead of depreciating just on the cost of the equipment, $100,000, actually the shipping and installation cost, we call it the capitalized expenditure, that can also be depreciated. And the business will like that because it will save them some tax, which by making that depreciation a larger number. So the total depreciable basis for this new equipment is $100,000 plus $50,000, that's $150,000. Now, also, after we purchase the new equipment, we have to increase our inventory level, and we have to increase our inventory level by $30,000. And part of that increased inventory is financed by our vendors. So our vendors are nice enough to allow us to pay them later after we can sell their products. So part of the inventory increase is financed with accounts payable, and that means accounts payable will increase by $5,000. So there are two changes in net operating working capital, and one is inventory. Inventory will increase by $30,000, and one is accounts payable, and accounts payable will increase by $5,000. Now, this new equipment will have some impact on the company's daily operation. So it will increase sales of its products by 100,000 units per year, and each unit will cost $3. So this new equipment will have some impact on the company's operation. So by buying the equipment, the company can increase their sales of the product by 100,000 units per year, and each unit will sell at $3. So in total, this new equipment will generate additional sales for the company of $300,000. And at the same time, when the sales increase, variable costs will also increase. And variable cost is 60% of the sales. So the variable cost will be 60% of $300,000. So that'll be $180,000. And the company's tax rate is 30%. And that 30% tax rate is both the operation tax rate and also the capital gains tax rate. Now, let's say the new equipment has 4 years of life, and it can be depreciated by using a straight line depreciation. So if we are using a straight line depreciation method, the company's depreciable cost is $150,000, and it has 4 years life. So $150,000 divided by 4, and that will give us $37,500 per year. So by using a straight line depreciation, each year the depreciation is $37,500. Now, at the end of its useful life, we can sell this new equipment at a salvage value, which is $40,000. The old equipment, the existing equipment, were replaced with this new equipment was purchased 3 years ago. And we spent $100,000 3 years ago on this existing equipment. And that $100,000 also includes the shipping and installation cost. And old equipment also had 4 years of life. So we purchased it 3 years ago. We have used it for 3 years, and there's 1 more year in terms of its life left. And the old equipment, we also use straight line depreciation to depreciate that. And that will be 100,000 divided by 4. So each year the depreciation is $25,000. And old equipment, if we sell it today, we can get $30,000 as a salvage value. Now, the project weighted average cost of capital is about 10%. So how do we estimate cash flows for this project? First, let's draw a timeline for the project's cash flow. This project has 4 years of life, so there will be 4 years on the timeline, and there will be 5 cash flows on the timeline. The cash flow at time 0, which is called initial cash outlay or initial cash outflow. Here we use free cash flow FCF 0 to stand for that initial cash outlay. And then each year we use the free cash flow N, or free cash flow 1, free cash flow 2, free cash flow 3, and free cash flow 4 to stand for those free cash flows. Now, let's look at the initial cash outlay, the free cash flow at time 0. So first, at time 0, we spend $150,000 in total to purchase, ship, and install this new equipment. So that will be our first cash outflow. And also we have to increase our inventory level by $30,000 and fund it partly by the accounts payable. So the accounts payable also increased by $5,000. So in terms of the change in net operating working capital, we have whatever the current assets were plus the $30,000, which is the increased inventory, minus the existing accounts payable, plus the $5,000, which is the increased accounts payable, and plus the accruals. So in terms of the net change in operating working capital, we have $25,000, which is $30,000 minus $5,000. The book value of the existing equipment, the old equipment that we replaced, is $100,000, which is the original price or cost we spent on the equipment, minus the depreciation over the 3 years of its life. So using the straight line depreciation, every year depreciation is $25,000. It has been 3 years. So 25,000 times 3. Now the total or the accumulated depreciation over that 3 years is $75,000. Now the original cost is $100,000. 100,000 minus 75,000, we have $25,000. So the book value at time 0 for this existing equipment is $25,000. Now if we can sell this old equipment by $30,000 in terms of salvage value, then we have a capital gain. That capital gain is the salvage value minus the book value of the old equipment. So 30,000 minus 25,000. That should give us $5,000. That capital gain itself is not a separate cash flow. So that $5,000 is part of the $30,000 proceeds of the salvage value. However, the capital gain tax, which is the $5,000 capital gains multiplied by the 30% tax rate, which is $1,500, that capital gain tax is a separate cash flow at time 0. So now let's look at the time 0. What is the free cash flow or the initial cash outflow? Now, equipment cost $100,000, which is cash outflow. Shipping installation $50,000 negative, which is also a cash outflow. So both of them are negative. And in total, the capex is negative $150,000. The change in net operating working capital is $25,000, which is cash outflow. So that is also a negative. So $150,000 negative minus $25,000. Now, the salvage value of the old equipment, $30,000, that should be positive because when we sell that, we should get a cash inflow of $30,000. However, the capital gain tax, $1,500, that is a cash outflow. So that should be a negative. So negative $1,500. So now in total we have negative $146,500. So that's the result of negative $150,000, negative $25,000, positive $30,000, negative $1,500. So in total, at time zero, we have a free cash flow, FCF zero, as negative $146,500. Now, after we calculated the initial cash outlay, we can calculate the interim cash flows of year 1 through year 4. So notice here, both the cash inflows and the cash outflows should be incremental cash flows. That include depreciation, although depreciation is a non-cash charge. So the depreciation should also be an incremental depreciation. That means with and without the project, what is the difference between depreciation? The equipment has 1 year of its life left at time zero. So if we have kept the old equipment, if we have not purchased the new equipment, we could still be using this old equipment for another year. In that case, we could still have depreciated on the old equipment for $25,000. However, because we purchased the new equipment and sold the old equipment, we forgo the opportunity of depreciating on the old equipment for $25,000. So between with the project and without the project, the incremental depreciation is not just $37,500 depreciation on the new equipment. It is actually the difference between the depreciation of the new equipment and the depreciation of the old equipment for its last year if we have kept it, so $25,000. So in the first year, the incremental depreciation between with the project, without the project, is the $37,500, which is the depreciation on the new equipment, minus $25,000, which is the depreciation on the old equipment for this last years of its life. And that is $12,500 as the incremental depreciation in year 1. In year 2, year 3, year 4, we don't have to account it for the old equipment depreciation because after year 1, the old equipment, if we have kept it, there's no depreciation on that anymore. So now let's look at the cash flows in year 1, year 2, year 3, and year 4. In year 1, this new equipment generate 100,000 additional unit sales. Each will sell at $3. So this new equipment will generate additional revenue by $300,000. It also generate additional operating costs, which is the variable cost. That is $180,000, 60% of the additional revenue. In year 1, there is an incremental depreciation of $12,500. So $300,000 minus $180,000 minus 12,500. So revenue minus variable cost minus depreciation, that will give us EBIT, which is the operating income. And in year one, that EBIT is $107,500. And notice here, we always ignore the interest expense, the borrowing cost, because that will be accounted for at the end when we discounted the cash flows by using the weighted average cost of capital. So that EBIT times 1 minus the tax rate, that will give us the NOPAT, or after-tax operating income. People also call it net operating profit after tax. So EBIT times 1 minus the 30% tax rate, that will give us NOPAT, net operating profit after tax, also call it after-tax operating income. That'll be $75,250. And we can also calculate this NOPAT by multiplying the tax rate with the EBIT. So 30% times EBIT, so in terms of the dollars, tax will be $32,250. And then subtract the tax from EBIT, that will also give us NOPAT. So 107,500 minus 32,250, that will give us NOPAT 75,250. Now, remember, depreciation is a non-cash charge. So that amount of cash, the company still has it. So we need to add back that depreciation in order not to underestimate the total amount of cash flows the company has. So adding back the depreciation, which is 12,500 incremental depreciation in the first year, our first year free cash flow is 75,250 plus 12,500, that'll be $87,750. In year two, year three, those cash flows are actually the same. Why? Because depreciation is the same. Here, the old equipment, if we have kept it, we do not have any depreciation on that. So in year two and year three, the additional revenue generated by this new equipment is $300,000. The variable cost is 60% of the additional revenue, which is $180,000, minus the depreciation on the new equipment, which is $37,500. Now, that will give us EBIT of $82,500. 30% of that EBIT is tax, so 30% times $82,500, that will give us $24,750. Subtract the tax from EBIT, we have the NOPAT, or the after-tax operating income. So in year two and year three, both NOPAT will be $57,750. Now, add back the depreciation, which is the non-cash charge. So the free cash flows for this company in year two and year three is $95,250. In year four, up to this point, the free cash flow is also $95,250. So additional revenue minus variable cost minus depreciation on the new equipment, we get EBIT, which is also $82,500. Subtract 30% tax, add back depreciation, that will give us $95,250 for year four's free cash flow. However, for year four, there's something additional. The last year's free cash flow is always different than the other year's free cash flow. So there are some additional cash flows after we get $95,250. Remember, we can sell this new equipment at a salvage value of $40,000. And by selling that, we will have some capital gains. By that time, since we are using the straight line depreciation method, at the end of its life, this new equipment will have a zero book value. So when they can be sold for $40,000, then the capital gains will be $40,000 salvage value minus 0 book value, and that capital gains will be $40,000. And the capital gain tax is 30% of the capital gains. So 30% times $40,000, the capital gain tax will be $12,000. So both the salvage value and the capital gain tax are separate cash flows. One is cash inflow, one is cash outflow. And also, remember we have to increase our inventory level, partly funded by accounts payable at the beginning of the project. Now, at the end of the project, when we finish this project, we can release that change in net operating working capital. So at the beginning of the project, it is a cash outflow when we have to increase the inventory level. And at the end of the project, this becomes a cash inflow since it's releasing that inventory level. And that change in net operating working capital will be $25,000 positive. So in total, for year 4's free cash flow, we will have $95,250 plus the salvage value, $40,000, minus the capital gain tax, $12,000, plus the change in net operating working capital, the release of the inventory level, which is $25,000. In total, we have the terminal year free cash flow, or free cash flow 4, which is $140,250. Now, once again, let's ask the same question. Should we consider the financing cost, such as interest expense and discounts, when we calculate these incremental free cash flows? And the answer is no, because later on, when we use the weighted average cost of capital to discount our free cash flows to get this present value, we will be accounting for the financing cost, including the interest expense and the dividends. Now, as a result of our previous calculation, here is our projected or estimated free cash flows for the project. At time 0, we have a cash outflow, a negative $146,500. At time 1, we have $87,750. At time 2 and time 3, we have $95,250. At year 4, we will have $148,250. In this chapter, we have covered 2 major topics. First one, we covered the guidelines for cash flow estimations in the capital budgeting process. The second topic, we went through a numerical example that shows how we estimate cash flows